Welcome to Early Age Club, where we break down one microcap or SME stock a day using our simple structured 20-factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So, Make Refrigeration Limited offers total cold chain and food processing solutions with energy saving and eco-friendly products and after-sale services. The company has currently five major verticals, which includes refrigeration solutions, including cooling, pre-cooling, mobile pre-cooling, blast chilling, blast freezing, storage, and display. The five verticals are cold room, which composes of around 48% of the revenue, commercial refrigeration contributing to 21% of the revenue, industrial refrigeration contributing to 5% of the revenue, transport refrigeration contributing to 9%, and ammonia and refrigeration products and projects contributing to 17%. Now they came up with their IPO in 2017. It was a fresh issue of 23.71 CR, out of which they spent 14.5 CR in CapEx, 1.5 CR towards brand enhancement like marketing activities, and they made an investment in Bharat Refrigerations Private Limited of 1.1 crore, which is their fully owned subsidiary. Now, this subsidiary has been loss making for the past 2 years, so this needs to be monitored. And they spend 5 crore on working capital requirements and 0.44 crore on general corporate purposes. So they spend highly on capex, so I gave them a 5 year. So, as of director and promoter track record, Mr. Chandrakant P. Patel is the chairman and managing director, and the rest of the joint managing directors, I presume, are his brothers, Mr. Rajendra P. Patel and Mr. Vipul I. Patel. So, together, the Patel family holds around 70.441% in the company, and Mr. Chandrakant Patel has a pledged percentage of 4.15%. He pledged 1.5 lakh shares very recently. I gave them a 5 year, but one thing to notice that their entire board, like they're very, their average is 50 plus. So we going forward, we need to monitor how they plan their succession, because that would be very crucial for their growth in the upcoming years. Regarding related party transactions, nothing very significant. There were minor transactions with subsidiaries of highest amount was around 11 crores, which was a sale with their Bharat Refrigeration Private Limited. So I gave them a 5 year. Board composes of 50% independent directors and 50% family on board. So I gave them a 5 year. And all the managing directors' salary is same. All three of them. It's 42 lakhs this year, and it was 27 lakhs last year. It is around 11% of sales. Nothing very major. So gave them a 5 year. Now there has been only two resignations, which is their secretarial auditor resigned in 2025 due to personal reasons, and their company secretary and compliance officer resigned in 2019. Nothing major, so I gave them a 5 year. Their auditor is their second term, and they have the tenure till 2029. So I gave them a 5 year. Regarding auditor opinion and credit ratings, auditor gave them an unmodified opinion in the past 3 years, and their rating got updated this year as compared to the past 2 years. So that's a good signal. And regarding regulatory or legal issue, nothing could be found. So I gave them a 5 year. Investor communication and disclosures, they do their presentation, con calls, and results. But one thing to notice is that when you click on their investor presentations for multiple quarters, all of them lead to one link which leads to the 2024 investor presentation. So they haven't updated that, or there might be a glitch. Either case, it's not there,
But
neither on the website. Regarding client concentration, so they don't have much business concentration risk. They are operating in 24 plus countries with 28,000 plus customers, 65 plus business associates with 50 plus product basket. Their industry-wise share of the revenue is 30 to 40% from dairy and ice cream, 15 to 20% from food processing and hospitality, and 15 to 20% from pharma and chemicals. 5 to 7% contribution they get from e-commerce, and from they get around 3 to 5%. Now this e-commerce segment is very important because it's more than e-commerce. It's basically quick commerce. They're trying to grow across this vertical because of the upcoming trend of black stores, so they're trying to expand there. So these are the revenues from business verticals as we had discussed. They're serving multiple industries like dairy, agriculture, cold chain, food processing, retail, pharma, and all of these. So industry-wise share also we discussed. Now they have a very robust clientele of all the major top brands which are operating mostly in India, like Amul, Coca-Cola, HUL, Monginis, and all that. Yeah. So they have domestic presence in all these states. The company representatives are in multiple states. Their branch offices are in 5 states, and they have a good dealer and associates network and with OEMs in India. They've got 5 plants here. So their latest plant is this one and they're also have another plant in Kolkata, West Bengal. These 2 plants are new, and rest of them are old. So the new plants are currently not operating at a very high efficiency, but due to automation and further developments, they are planning to make them as efficient as the legacy plants. So they have international presence in 24 countries. They are also targeting major part of Africa and also trying to enter into Middle East. They also have some dealers and associations in USA and in the Middle East, and they're also targeting on expanding in Nepal. So the next part would be the financials. So revenue growth versus receivables. Revenue growth has been robust over the past 4 years, and but receivables has grown a bit in a higher percentage as compared to revenue. As we can see, the receivables as a percentage of revenue has grown over the years, but it's still 20%. So I gave them a 5 year. They're planning to increase their revenue in PUF panels, which is the new vertical, to 225 to 250 crores, and their commercial freezer segment to 130 crores in the coming years. For fiscal year 2026, they're targeting the entire summation to be around 175 crores from these 2 new segments. Now PUF panels have very widespread application. Like it's not just used in refrigeration; it's also used in heating, ventilation, and air conditioning systems in PEBs. So they're trying to get long-term contracts with the PEB companies so that they can install these panels and generate a very high portion of revenue from the PEB growth segment. So operating cash flows as a percentage of EBITDA is around 70%, which is very good in my opinion. It was 24% last year, which it happened because since the receivables are constantly increasing, but they are also stretching their credit terms with in terms of payables also. So that's why they have maintained a good OCF by EBITDA. But in 2024, payables were low. They paid off a lot of their payables, so it came down to 24%. I gave them a 5 here because they say it's nice. Inventory trends, inventory days is a bit on the higher side, but it just went from 63 to 85, whereas inventory value doubled in 2025. So I am not flagging it as a very big red. We can consider it as a yellow. And days sales outstanding has been 63, which is not very high, so I gave them a 5 here. And cash conversion cycle has been stable over the past 3 years. It reduced significantly in the last 5 years, so I gave them a 5 here. Yeah, debt to equity ratio has increased significantly over the past 3 years. It's still manageable as long as it's less than zero point 0.7 or zero point 0.8, and interest coverage is 9.1. I believe that once their new revenues start coming in from the new plants and they start operating at good efficiency, their interest coverage is likely to increase. And debt to equity is around 3.5 times in fiscal year 2025 as compared to 2024. So that's something that needs to be noted, that they did a majority portion of their capex from raised funds through
In
debt. So capex as a percentage of revenue is 17% this year. It increased significantly. The company is focusing on achieving a very high growth. Fixed asset turnover is around 5 and asset turnover is around 1.6. Return on invested capital is 16%. All these three figures have declined over the past 3 years because they have done heavy capex, whose returns are yet to materialize. Fiscal year 2026 capex plan is around 20 cr, mainly on maintenance and automation in cold rooms. Their future capex plans from fiscal year 2026 to 2028 is around 150 to 200 cr, of which they're targeting potential acquisitions and collaborations which are in early stages, and they're also focusing on automation efficiency and capital capacity expansion, which is their phase 2 of growth. Basically phase 1 is has already been completed but the revenue is yet to materialize. So So liquidity position, quick ratio is 0.6, which is a bit concerning. They're operating at very low cash. Current ratio is 1.3, so it's a bit on the lower side. So they might face liquidity challenges. That's why I give them a 3 here. Return on equity and return on capital employed is good. Return on asset has declined mainly due to the capex. So what the management mentioned was that margins were impacted by higher depreciation and interest costs due to new capex and incremental operations cost from new plants, which we can see in the growth consistency figures as well. So the revenue growth has been good. Gross margins have also increased, but EBITDA margin has declined by 2%. PAT margin has declined by 2%, and PAT growth has declined by minus 13%. This PAT decline happened due to margin dip, higher interest cost, and higher depreciation. Depreciation was, I think, double as compared to last year. Interest cost has also significantly increased, and the margin dip of 2% hit them hard. So their last 5 year growth trajectory is very important to understand. They entered into daily dairy processing segment in 2020, and then they introduced low temperature, low humidity, cooling systems for farm and food processing sector. They enhanced their manufacturing facility and upgraded health and safety norms in 2019. In 2021, they expanded manufacturing facility in the Gujarat. Then they launched solar cold room brand with the name Solo Perish in 2022. They also expanded manufacturing facility to PUF panels, which I mentioned is a very good growth segment through their Kolkata plant in 2023. These two plants are the two heavy capex they have done in phase 1 of their growth. And they have also unveiled a new manufacturing facility for PUR and PUF panels for chest freezers and visi-coolers in their Gujarat and Ahmedabad plant. They are also highly bullish on their visi-coolers growth, so that's something we need to. So they're heavily focused on the customized freezer and chillers for dark store trend. They think that this segment is going to do good in the upcoming years, and they are also upgrading their continuous PUF panels, so it has multiple application. Now their primary focus earlier was in refrigeration and cold storages, but yeah, they are now trying to expand to the new construction projects and PEBs, which would bring in a lot of revenue. So their offerings are in cold room and storage products, solar cold rooms, commercial refrigeration products, industrial and transport and ammonia refrigerations. In 23-24, a significant portion of their sales came from their dealerships and OEM partners. It was around 56%, and they have also got high engagement from East, North, and South. They're trying to expand their focus on West and on their exports, which contributed around 3% in sales. So regarding their industry projections, this is what they mentioned, that the Indian industry size is around 2052 billion rupees in 2024. and it would be around 5,596 billion rupees by 2032. So there is a 11.4% CAGR expansion during the 2024 to 2032 period, and the global industry size is around 441 billion USD, which is expected to grow at 679 billion USD by 2028. So 13%, 13.3% CAGR around the same period. So this the industry is growing very highly. So they have a very good opportunity to expand. And regarding the what the management is saying and what the order book is, I'll mention the write up. So the management is targeting 1,000 crore top line growth in the coming 3 to 4 years. It scored 96 in our framework, and it looks promising. But we need some time to see their management matches the revenue projections.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today, I mean, I like the way the management was consistent, and I was just checking screener. They have been consistently delivering. It has been a multi-bag over the last 5 years. So yeah, they have been delivering, and also they have been consistently paying dividends, which is good. Promoter holding is high. PE of 53 currently, but then once margins improve, I think the 1 year forward PE would be around 30. So let's quickly, okay, I'll run the smart analyze just to see if the price at which it is trading. Yeah. So based on P, I mean margin expansion and also normalizing, the historical growth. I It is throwing a future number of 1,100. So currently it's trading at 800. So that is, I mean, you have to take it with a pinch of salt. But then bull case, you can get 1,100 as your target price for the next 1 year. And one more thing which I notice is it is very seasonal. So most of the revenue, if you see, are realized during the March quarter. Quick commerce vertical is something I would be keenly looking for, someone who is looking for a proxy for quick commerce. I think this makes a wonderful proxy. And also some important things which I really liked is that they have advance order of around 50 crores that the quick commerce company have given them to, so that there's no supply disruption during the expansion phase of the dark stores. So 50 crores of advance payment they have given. So that is really interesting. It also says the kind of moat the company has made, and these are very niche industrial coolers. So the companies and the organizations are very specific as to after sales service, etc. And I think ice maker, refrigerator, being in the industry for so long, has made that mark. So in terms of reverse DCF, so let's just quickly calculate. So the profit before tax is around 31, and let's take an average of both, or it's better to take 31. So the cash flow conversion is also good. Basically, this is the operating cash flow. So the cash flow conversion is also good. And as an investor, if you're expecting a 20% CAGR return and a terminal growth rate of 5% for the next 5 years, I would give a lower 5-year multiple, because to be on a conservative side. So the company has to conservatively grow or compound its earnings growth rate at 32% to justify the current valuation or our return expectation. So in order for us to realize 20% return on the current, the company has to grow at 32%. If you reduce the discount rate, the implied growth rate reduces. So if you do it. If your expectation is 15, the company has to grow at 27%. But considering that company is aiming to reach 1,000 crores in the next 4 to 5, 2028 is their target. They had a target of 500 crores for 2025, but it slightly missed. They cited elections as the reason, but overall, I like the management quality based on whatever analysis we have done. So, how this would definitely go into the second phase of deeper research. One of those companies where we would like to go deeper into research to understand the moat, the valuations, the business fundamentals, the industry drivers, etc. So, a promising company to have it in your tracking list, definitely. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.